Hey, what's going on, guys? It's Ricky, and Jerome Powell should be going live in just 3 minutes, and he is going to be speaking on the economic outlook, inflation, and the labor market. In very simple words, we're pretty much looking to have a better understanding of, what the next interest rate hike is going to be. So I hope that you guys learned something new. Please make sure that you guys subscribe. I upload new videos every single day about the stock market, and I would love to be of value for you. All you literally have to do is send me a direct message via Instagram or Discord, which is the first or third link in the description down below. Anytime that you have any questions, I cannot help you if you do not reach out. Friendly reminder, I have one Instagram account. It's linked, third link in the description. I'm verified, and that is my only Instagram account. I can promise you every other account is fake. I will never message you first. I will never ask you for money. I will never trade for you. I just want to make sure that I explain that to anyone that is new to following me, because there's fake accounts for every finance YouTuber or influencer that will pretend to reach out to you asking you for money. So please make sure that you're aware of that. Look out for yourself. The only thing that I offer is learn, plan, profit, and that's to be able to watch me trade live every day. And that's that second link in the description if you want to save $150 off. So should be in 1 minute that the Federal Reserve should be going live, and we got Big JP going to be talking today. So it should be fun. I hope that you guys enjoy. How are you guys all doing today? Doing good? Feeling good? NASDAQ market is as choppy as it ever is. Lows, highs, lows, highs, lows, highs. If you guys follow me on Instagram, if you guys watched our live trading session today, we literally talked about this, market's literally just anticipating what's to be said. No one knows what's going to happen. You can try to predict as much as you want, but at the end of the day, it's all about what is actually said. And here it goes. It should be any second now. There we go.
I'm Glenn Hutchins, co-chair of the Brookings Board.
Best of luck.
On behalf of our president and some of my fellow trustees who are here in the audience today, it's my great pleasure to welcome all of you, both our post-pandemic in-person audience here, packed house, great to see, as well as our sizable broadcast and online audience. Thank you for joining us today. When President Obama named Jay Powell to the Federal Reserve Board governor in 2012, no one, including I suspect Jay, expected him to become Fed chair. When President Trump named Jay Powell as the Federal Reserve chairman in 2018, hardly anyone anticipated the global pandemic. And don't forget that then the Fed's challenge was too little, not too much inflation. So Jay Powell has repeatedly been forced to confront the unexpected and had to steer the United States economy through uncharted waters. He's done it with a steady hand, great personal integrity, independence, and an unwavering commitment to the Fed's dual mandate, price stability, and maximum sustainable employment, though I don't think I need to explain any of you that today, despite stiff headwinds, both economic and political. So we're pleased to welcome to the stage today, on behalf of the Brookings Institution and the Hutchins Center on Fiscal and Monetary Policy, Jay Powell. Following his remarks, Mr. Powell will field questions from David Wessel, the director of the Hutchins Center, and from the audience. Jay, thank you for joining us.
Big JP. Oh my goodness.
Thank you, Glenn. It's great to be here today. It's great to be back at Brookings. So today I'm going to offer a progress report on the FOMC's efforts to restore price stability to the U.S. economy for the benefit of the American people.
Be careful.
And that report must begin by acknowledging the reality that inflation remains far too high.
Oh, that's not good.
My colleagues and I are acutely aware that high inflation is imposing significant hardship, straining budgets, and shrinking what paychecks will buy. This is especially painful for those least able to meet the higher costs of essentials like food, housing, and transportation. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. We currently estimate that 12-month PCE inflation through October ran at 6.0%. While the October inflation data received so far showed a welcome surprise to the downside, these are a single month's data, which followed upside surprises over the previous 2 months. As Figure 1 makes clear, down months in the data have often been followed by renewed increases. It will take substantially more evidence to give comfort that inflation is actually declining, and by any standard, inflation remains far too high.
This is not good. I don't know why the market's
For
going
purposes of this
up.
discussion, I'll focus my comments on core PCE inflation, which omits the food and energy inflation components, which have been lower recently but can be quite volatile. Our inflation goal is for total inflation, of course, as food and energy prices matter a great deal for household budgets.
Yep.
But core inflation often gives a more accurate indicator of where overall inflation is heading. 12-month core PCE inflation stands at 5.0% in our October estimate, approximately where it stood last December when policy tightening was in its early stages. Over 2022, core inflation rose a few tenths above 5%, and it fell a few tenths below, but mainly it moved sideways. So when will inflation come down? I could answer this question by pointing to the inflation forecasts of private forecasters or of FOMC participants, which broadly show a significant decline over the next year. But forecasts have been predicting just such a decline for more than a year, while inflation has moved stubbornly sideways. The truth is that the path ahead for inflation remains highly uncertain. For now, let's put aside the forecasts and look instead to the macroeconomic conditions we think we need to see to bring inflation down to 2% over time. For starters, we need to raise interest rates to a level that is sufficiently restrictive to return inflation to 2%. There's considerable uncertainty about what rate will be sufficient, although there's no doubt that we've made substantial progress, raising our target range for the federal funds rate by 375 basis points since March. As our last post-meeting statement indicates, we anticipate that ongoing increases will be appropriate. It seems to me likely that the ultimate level of rates will need to be somewhat higher than thought at the time of the September meeting and the summary of economic projections. I will return to policy at the end of my comments, but for now I'll simply say that we have more ground to cover.
Not good.
We're tightening the stance of policy in order to slow growth in aggregate demand. Slowing demand growth should allow supply to catch up with demand and restore the balance that will yield stable prices over time. Restoring that balance is likely to require a sustained period of below-trend growth. Last year, the ongoing reopening of the economy boosted real GDP growth to a very strong 5.7%. This year, GDP was roughly flat through the first 3 quarters, and indicators point to modest growth this quarter, which seems likely to bring the year in with very modest growth overall. Several factors contributed to this slowing growth, including the waning effects of reopening and of pandemic fiscal support, the global implications of Russia's war against Ukraine, and our policy actions, which tightened financial conditions and are affecting economic activity, particularly in interest-sensitive sectors such as housing. So we can say that demand growth has slowed, and we expect that this growth will need to remain at a slower pace for a sustained period. Despite the tighter policy and slower growth over the past year, we have not seen clear progress on slowing inflation. To assess what it will take to get inflation down, it's useful to break core inflation into 3 component categories.
This doesn't sound bullish at all.
Housing services inflation, and inflation in core services other than housing. Core goods inflation has moved down from very high levels over the course of 2022, while housing services inflation has risen rapidly. Inflation in core services ex-housing has fluctuated, but shown no clear trend. And I'll discuss each of these items in turn. Early in the pandemic, goods prices began rising rapidly as abnormally strong demand was met by pandemic-hampered supply.
Please be
Reports from
careful
businesses
for a
and
bull
many
trap.
indicators
Just a
suggest that
reminder.
Supply chain issues are now easing. Both fuel and non-fuel import prices have fallen in recent months, and indicators of prices paid by manufacturers have moved down. While 12-month core goods inflation remains elevated at 4.6%, it has fallen nearly 3 percentage points from earlier this year. It is far too early to declare goods inflation vanquished, but if current trends continue, goods prices should begin to exert downward pressure on overall inflation in coming months. Housing services inflation measures the rise in the price of all rents and the rise in the rental equivalent cost of owner-occupied housing. Unlike goods inflation, housing services inflation has continued to rise and now stands at 7.1% over the past 12 months. Housing inflation tends to lag other prices around inflation turning points, however, because of the slow rate at which the stock of rental leases turns over. The market rate on new leases is a timelier indicator of where overall housing will go over the next year or so. Measures of 12-month inflation in new leases rose to nearly 20% during the pandemic, but have been falling sharply since about mid-year. As Figure 3 shows, however, overall housing services inflation has continued to rise as existing leases turn over and jump in price to catch up with the higher level of rents for new leases. And this is likely to continue well into next year. But as long as new lease inflation keeps falling, we would expect housing services inflation to begin falling sometime next year. Indeed, a decline in this kind of inflation underlies most forecasts of declining inflation. Finally, we come to core services other than housing, and this spending category covers a wide range of services, from healthcare and education to haircuts and hospitality. This is the largest of our three categories, constituting more than half the core PCE index. Thus, this may be the most important category for understanding the future evolution of core inflation. Because wages make up the largest cost in delivering these services, the labor market holds the key to understanding inflation in this category. In the labor market, demand for workers far exceeds the supply of available workers, and nominal wages have been growing at a pace well above what would be consistent with 2% inflation over time. Thus, another condition we're looking for is the restoration of balance between supply and demand in the labor market. Signs of elevated labor market tightness emerged suddenly in mid-2021. The unemployment rate at the time was much higher than the 3.5% that had prevailed without major signs of tightness before the pandemic. Employment was still millions below its level on the eve of the pandemic. Looking back, we can see that a significant and persistent labor supply shortfall opened up during the pandemic, a shortfall that appears unlikely to fully close anytime soon. Comparing the current labor force with the Congressional Budget Office's pre-pandemic forecast of labor force growth reveals a current labor force shortfall of roughly 3.5 million people. This shortfall reflects both lower than expected population growth and a lower labor force participation rate. Participation dropped sharply at the onset of the pandemic because of many factors, including sickness, caregiving, and fear of infection. Many forecasters expected that participation would move back up fairly quickly as the pandemic faded. And for workers in their prime working years, it mostly has. Overall participation, however, remains well below pre-pandemic trends. Some of the participation gap reflects work.
Excuse me, I'm caught in awe. If anything, if this is a bull trap, this reminds me so much of our two CPI data reports ago. Market went up and then market quickly corrected itself. All I'm ever here to encourage you to do is, if you find it to be too risky, follow with the trailing stop loss, follow with a stop loss, something to lock in profits if you're trading this. Please, I don't want you to get caught on the wrong side of a trade.
So health issues have surely played a role, as COVID has posed a particularly large threat to the lives and health of the elderly. In addition, many older workers lost their jobs in the early stages of the pandemic when layoffs were historically high. The cost of finding new employment may have appeared particularly large for these workers, given pandemic-related disruptions to the work environment and health concerns. Also, gains in the stock market and rising house prices in the first 2 years of the pandemic contributed to an increase in wealth that likely facilitated early retirement for some people. The data so far do not suggest that excess retirements are likely to unwind because of retirees returning to the labor force.
I like that, Umar.
Older workers are still retiring at higher rates, and retirees do not appear to be returning to the labor force in sufficient numbers to meaningfully reduce the total number of excess retirees. So, the second factor contributing to the labor supply shortfall is slower growth in the working age population. The combination of a plunge in net immigration and a surge in deaths during the pandemic probably accounts for about 1.5 million missing workers.
285
Policies to
resistance.
support labor supply are not the domain of the Fed. Our tools work principally on demand. And without advocating any particular policy, however, I will say that policy to support labor force participation could, over time, bring benefits to the workers who join the labor force and support overall economic growth. Such policies would take time to implement and have their effects. For the near term, a moderation of labor demand growth will be required to restore balance to the labor market. Currently, the unemployment rate is at 3.7%, near 50-year lows, and job openings exceed available workers by about 4 million. That is about 1.7 job openings for every person looking for work. So far, we've seen only tentative signs of a moderation in labor demand. With slower GDP growth this year, job gains have stepped down from more than 450,000 per month over the first 7 months of the year to about 290,000 per month over the past 3 months. But this job growth remains far in excess of the pace needed to accommodate population growth over time, about 100,000 per month by many estimates. Job openings have now fallen by about 1.5 million this year, but remain higher than at any time before the pandemic.
Very quickly, I think that this is a great sign that market is just, it's finding any specific reason on why to go up, right? We've talked about this before where we can't be surprised if the market does sell off, but I think with what we've seen so far, we still have that Fed interest rate hike, but with what we've seen so far, it looks like we're very, very close to the bottom, at least for now. So I think this is a step in the right direction, but please, do not be hopeful if you're a day trader. If the stock is moving up, right? If direction is in your favor, have an exit plan in place. A goal without a plan is a plan to fail. It doesn't matter where you set it at, right? One of the worst feelings ever is going from a green trade to a red trade. So put yourself in a position in which you can tolerate. Even reducing your position size a little bit, you're never going to be perfect. Don't be perfect. Don't try to be. Just be good. Make sense of your entries, make sense of your exits. That's all I have to say. I want you guys to keep these profits. I don't need you guys to be scared. You can continue to hold, but if there's a change of direction, what does that look like for you? Okay?
2% inflation over time. So despite some promising developments, we have a long way to go in restoring price stability. Returning to monetary policy, my FOMC colleagues and I are strongly committed to restoring price stability. After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time.
That's not good news.
Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. The time for moderating the pace of rate increases may come as soon as the December meeting. Given our progress in tightening policy, the timing of that moderation is far less significant than the questions of how much further we will need to raise rates to control inflation and the length of time it will be necessary to hold policy at a restrictive level. It is likely that restoring price stability will require holding policy at a restrictive level for some time.
Not good.
History cautions strongly against prematurely loosening policy, and I'll close by saying that we will stay the course until the job is done. Thank you.
That's not good. No pivot so far. They talked about possibly slowing down, but no pivot so far.
Thank you very much, Chair Powell. I think you spared me the chore of asking you to pick between 50 and 75, so I won't have to ask you that. Thank you for your last paragraph. But I want to talk a little bit about wages and inflation. So, as you said, wages are rising faster than is consistent with a 2% inflation rate, assuming reasonable profit.
Remember, just because the market is dropping a little bit doesn't mean that you have to sell your TQs and go into SQs. Remember, anytime that you open a position, you're open to risk. There is no confirmation that we are selling off. If you lock in profits on TQs, that's one thing. It doesn't mean that you have to enter the other side hoping for the market to sell off. You can lock in profits and you could have done that well. It doesn't mean you always have to trade the other side. More often than not, you'll put yourself in a bad position. Just remember that.
At the beginning this episode back in March of 21 was not really related to wages at all. It was related to tightness in goods markets, largely due to supply chain issues. Over time, though, inflation is now spread broadly through the economy. And while I would still say that the inflation we're seeing now is not principally related to wages, we think that wage increases are probably going to be a very important part of the story going forward, particularly as it relates to that third category of core services ex housing. So we think it is an important thing going forward. And ultimately, in the service sector in particular, where wages and benefits are by far the largest cost, wages need to go up. And of course, we want wages to go up. We want wages to go up strongly, but they've got to go up at a level that is consistent with 2% inflation over time, making basic assumptions about productivity. So if you look at the principal wage measures that we look at, I would say that you're 1.5% or 2% above that with current wage increases.
Wow.
So particularly the employment compensation index and
Jesus.
The average hourly earnings index. Look at those two. It's about 1.5% higher.
Remember, even if it's a day trade, right? If you don't trust that this is going to last for a long period of time, even if it's a day trade, you don't need to be scared to take advantage of it. Remember, a great way to manage risk is to manage your position size. You can buy 1 share, you can buy 5, you can buy 1,000. Do not buy more than you can tolerate at worst case scenario. Please remember.
Everyone looking for a job. The so-called jobs workers gap is about 4 million, meaning if you look at all of the available jobs, including people who are working.
Isn't this so much fun? No, just me? It has to be fun for you guys too.
There's a 4 million shortfall. So you're in that world, and we think that there's a job for moderating demand in there and getting the labor force back into balance.
You don't think that there's a possibility that we should have a period of catch-up of wage increases above the sustainable level, and that businesses with relatively fat profit margins can absorb some of that without passing it through?
So that's the question of the worker share of profits and that kind of thing is not really related to this. Right now, people's wages are being eaten up by inflation. So what you want to do is you want to have inflation stable and then have a very strong labor market where the biggest wage gains are going to the people at the bottom end of the spectrum. And we had that at the end of the very long expansion that ended with the pandemic. That's not what we have now. Now, for most workers, the increases they're getting in wages are being eaten up by inflation. That's actually not true at the bottom end, where wage increases are higher than inflation. And that's a good thing. But if you want to have sustainable, strong labor market, where real wages are going up right across the wage spectrum, especially for people at the lower end, you got to have price stability.
Do you guys see that Rolex on JP's arm?
We can't get back to that place where we kind of were for the 2 years before the pandemic hit.
And did you take, when you look at today's JOLTS data, which measures the vacancies and quit rates, did you find that encouraging?
More or less in line with expectations, but that's
going the right direction.
That's a good thing, right? So I guess job openings came down by several 100,000 to where they are now, and that's a positive thing. As you know, the relationship between job openings and unemployment is a very fraught one, and job openings right now compared to unemployment are at near their all-time high levels. So it has been our view that there's a possibility that in this highly unusual situation in the labor market could come back into balance to some extent through a decline in job openings.
Remember, the reason that they're asking him about job openings is because the Federal Reserve has a goal of like 4.1 or 4.4% unemployment by next year. Right now, it's currently at 3.9 or 3.7. So they want unemployment to increase, right? They want the economy to feel the pressure. Remember that. So their goal is for things to actually slow down. And what they're saying right now is for every person that's actually looking for a job, there's 1.7 jobs available for every one person that's looking for a job. Meaning that's not good, right? And someone just made a funny joke of like, I just bought JP that Rolex with what I made off of the stock market. That's funny.
Pointed out that job vacancies is starting to come down. But to the extent that the Fed still relies on a Phillips curve kind of relationship, going forward, is the natural rate of unemployment a useless concept? How will what measures will the Fed use to judge labor market slack as we look ahead to policy in the coming years?
You guys see that? Signs of a resistance. Just be
The way
careful.
we think about it, of course, the standard way to think about it is it's the gap between the actual unemployment rate and the natural rate of unemployment that matters, right? And the issue really, it's not that that framework doesn't make sense. It does make sense. But the issue is that the natural rate of unemployment is very hard to identify with certainty, even in normal calm times. But when there's a violent disruption of the labor market, it can move very substantially. So, and that happened at the beginning of the pandemic. You had the labor market was very much disrupted, and we assumed that the natural rate had moved up, meaning that for any level of unemployment, the labor market is tighter. So we knew that. And I think what was different in this cycle was really that you had to look at things like job openings and quits and reservation wages and just wages overall to tell you that the natural rate of unemployment had really moved up quite a lot. But I don't think it's a problem with the framework, but it is a fact, though, that it's very hard to pin down where the natural rate of unemployment might be when there's this massive disruption in the labor market going on.
So do you think that the JOLT state of the job vacancies per unemployed worker, that's going to be a lasting measure of labor market tightness for you at the Fed?
Yes, I think people will tend to look at it.
Well, when you tell them you're looking at it, they tend to look at it.
They'll look at it.
I've noticed that.
That's right. I think I would just say in this particular situation, we think it's important, and we're going to find out empirically whether that was true. For the reasons I explained, we think that we can see a big decline in job openings and less than you would expect of an increase in unemployment. So this was a unique.
Since we're on the topic about a Rolex, I actually just spoke to our team this morning, and I don't know what you guys. I mean, we're just talking about JP's Rolex that he has going on. We just did a giveaway for. We just did a giveaway for TechBuds Apparel. We're thinking of giving away in the month of December. We're running one giveaway. It's going to be 30 days and giving away a Rolex. You guys let me know in the comments section what you think and if you think that would be a good idea. So if you buy anything on the site, you get automatically entered to win a Rolex. Drop a thumbs up if you think that we should do that.
Do you share that?
So this is a great set of questions that we've all been thinking about a lot, and Lael's speech was really terrific on that. Augustin Carson has given a couple of speeches on the same topic, including one at Jackson Hole this year.
The head of the Bank for International Settlements.
Yes, exactly. The question is, is the new normal going to be unlike this normal that we've had where supply side disruptions and constraints were relatively, you could look through them. The lore has been for a long time that you don't need to worry about that. It'll sort itself out, a supply shock from oil prices or whatever. Are we going into a situation a little bit like the 70s where there will be ongoing repeat shocks, and which would tend to put more upward pressure on inflation over time? We don't really know. I mean, it's a great question. But the question, I guess the real question is, if that's true, what are the implications? We still have a 2% inflation target, and we still have to use our tools to achieve it.
TQQ almost at 5%, team.
But
Same resistance as of now.
Very hard to know. It's very hard to know the answers to these things. I mean, we tend to assume things will go back to the way they were just naturally, but that doesn't seem to be happening so far.
Right. Now, you mentioned in your remarks that forecasts of inflation have, not only those at the Board of Governors, but in the private sector as well, have been lousy. Inflation has not behaved the way the forecasters said. So I wonder how you think about using forecasts of inflation and making policy. If you can't tell us, or if your staff can't tell you with some degree of confidence what inflation is going to be 6, 12, 18, 24 months out, how do you think about that in deciding when you make policy decisions?
So I'll say that it is very difficult to forecast inflation now, and one of the reasons is just
happy to have you, Eddie.
The situation is so different from the normal one, and as I mentioned, a lot of it is just that the difficulty is just these supply side constraints that we've had. We had no experience in forecasting that. It was this was a case of first impression. So that was very difficult. Nonetheless, we do make forecasts. We'll continue to make forecasts. the way I tried to get around
There it
that
goes.
in my remarks was
New
to say,
highs.
let's put the forecast aside for a second and let's try to identify the macroeconomic conditions that we think
Where
can
are my
indicate that we
bulls
put
at?
downward pressure on
Where
inflation.
are my bulls?
So
Let me see it in the
that's
chat.
what
If you're a
we'll
bull, make sure you
continue
smash
to make,
that like button.
forecasts, but
Smash.
we're gonna have to
And
be
if you're a
humble and
bull,
skeptical
you
about forecasts,
better
I think,
have
for
some form of
time.
exit
And
plan.
that
If
calls
you're a
for
day
risk
trader, right? If you're an
management,
investor, you know, you have your own plan.
really
If you're a day
difficult
trader,
forces that
you
monetary
better
policy
have,
works
for
with
your
long
own good,
variable
not for me,
lags
not
and
for anyone
together
else,
with inflation,
for your own
is
good.
at the end
It
of
better
that time.
be
And so
a trailing
if you're
stop loss, a
waiting
stop
for
loss,
actual
something
evidence
to lock in
inflation's
profits.
coming down,
I want you to lock in
it's
profits
very
when it
difficult
makes
not to
sense to you.
over-tighten if that's all you're doing.
Let's
So
see it. We
we
have
have a risk
724
management, balance to
bulls.
strike,
Can
and
we
we
hit
think
a?
that
Do we have
slowing down
1,000
at this
bulls?
point is a good way to balance the risks of
Slowing down on the pace of
22,
rates.
22, 22. Check that bad boy
It's still
out.
a problem if you can't use today's inflation rate to set policy and you're not sure what tomorrow's inflation rate is. You're saying the inflation forecast will be secondary to the economic conditions that you think are likely to generate more or less inflation. Is that basically?
Why does he sound so
First of all, I'm
rough?
agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I
I'm the
gave you those
1,000th
three pieces
fool.
and the very
I like that.
elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions. For example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what that is.
Have an exit plan, please. Not that you need to sell now. That's not what we're saying.
Policy.
Have an exit plan if
restrictive,
direction
and
begins to
that often
change.
is used
Always
as
prepared.
The definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it, is we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be.
Oh,
they
boy.
tighten. So we
Too
monitor the
good.
tightening of financial conditions. We look at the history of these financial conditions index and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the Treasury rate curve, we'll look to see significantly positive real rates across the curve, and you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation, and I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look though at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether looking at put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we estimate as the longer run neutral rate. Mm-hmm. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium. That isn't where we are.
Yeah, I noticed. Can I turn to the balance sheet for a minute? I'm going to turn to questions from the audience in a minute. What criteria are you going to use to decide when to end the shrinking of the balance sheet? Is it the economy? Is it whether money markets are functioning well? Is it whether the Treasury is having trouble raising money? How do you decide when you've shrunk enough, when you end the shrinking?
So I should refer you to a document that lays all this out in detail, that I really should be reading to you, but I'll paraphrase it.
Thank you.
If I don't get it exactly right.
No one will pay attention if you don't get it exactly right. Don't worry about it.
Wing it.
Relax.
So we're in an ample reserve regime, and what that means is that changes in the reserve level will generally not affect the federal funds rate. So there's more than enough reserves in the system. So we're not close to reserve scarcity. So what we said is that we would allow reserves to decline until we're somewhat above the level that we think is consistent with an ample reserve, with scarcity.
Right.
And then for a while, what you do is you hold the balance sheet constant, and non-reserve liabilities grow while reserves shrink. So we sort of shrink gradually down to that. And then at a certain point, we're just going to call it. We're not looking to really go back into proving that they're scarce, because what happens is, and you saw this back a few years, the demand for reserves is not stable, and it can move up and down very substantially. So we want to stop at a place that's safe. Having a lot of reserves.
Slight signs of a resistance here for TQQQ. Just be careful.
Benefit to have plenty of reserves, plenty of liquidity in the markets and in the banking system and the financial system generally. So that's how we would do it.
In the minutes, the last FOMC meeting, it said the staff had a forecast that it forecasts below potential growth, but not a recession. But then there was this interesting sentence where the staff said the possibility that the economy would enter a recession sometime over the next year is almost as likely as their baseline forecast. Is that where you look at it?
You guys see that common resistance range?
I have resisted the temptation to handicap it.
288.
I think I'll continue to
290.
I get
Okay.
the way I think.
Be
of it
careful.
is I do continue to believe that
I
there's
love
a path
this.
to a soft or softish landing. I do believe that, and
And the definition of a softish landing is what?
Soft.
Unemployment goes
Here,
up a little. But
I'll speak after this.
Yeah, unemployment goes up, but it's not a hard landing. It's not a severe recession.
JL, you have to be
We think
nice.
of Unemployment going up, but not really spiking as it does in some recessions. So that's how I think about it, and I think the path is pretty clear. It's the labor market conditions soften. We see inflation, and the goods inflation gets better, housing services inflation gets better, and the labor market softens. But it doesn't go into recession.
Goodness.
And you see inflation.
Oh, just broke above 287.50.
I don't want to be the handicapper on it, and of course our job is to try to achieve that, and I think it's still achievable. Although if you look at the history, it's not a likely outcome. But I would just say this is a different set of circumstances.
So you said at the last press conference that you thought the path to that soft landing had narrowed. Has it continued to narrow, or is it widened, or I don't know if you can have a wider soft landing, but
I don't know that it's changed since this is what 5-6 weeks ago. I was asked the question: has it narrowed? Is it still possible? And has it narrowed? It's definitely still possible, and it has narrowed because if you look over the course of this year, nobody expected us to raise rates this much. No one expected inflation to be this strong and this persistent and this
is insane.
to have spread so broadly through the economy. And so to the extent we need to keep rates higher or keep them higher longer, that's going to narrow the path to a soft landing. On the other hand, if we get good inflation data and we get evidence that all the things that I talked about, if all those things start to swing the other way, then we could very much achieve this.
in August 2020, you announced a new framework for monetary policy, the flexible average inflation.
I am in a position. I'm trading off of my phone. I'm sure you guys can guess what I'm in. I'll show you SQQQ, what I have. I have one lucky share. Someone thought that I was shorting the market. They're like, Ricky, how much are you down? I hold one share of SQQQ. So we had someone get upset last time I hosted a live stream, believe it or not. And it was a free live stream. It's like this. And they're like, Ricky, you are trying to encourage other people to trade the same thing. I just want to use this as an example. I am trading something. It's obviously not SQQQ. You guys could imagine what it is. I'm very grateful for how it's playing out. I just didn't want to be a reason on why you buy or why you sell a specific position, right? I wanted you guys to make your own decision. This is not a Learn, Plan, Profit live stream. I'm not here to instruct you. That's the live stream that I host with my Learn, Plan, Profit group every morning. So just making sure that you guys are aware. Again, it's what I was asked to do. So I'm here to do it, especially when it's free. And if that's the whole point of LPP. So
Until we saw both maximum employment and price stability, I don't think I would do that again.
Because
I think it limited. It's the tail risk. We tend as human beings to underestimate tail risk, and I think we didn't think it seemed so unlikely. If you remember, 25 years of low inflation,
right.
and many years after the pandemic, after the global financial crisis of inflation everywhere in the world, it's all disinflation. Just didn't seem likely, and yet here we are.
So it turns out that when you invite the chairman of the Federal Reserve to speak at Brookings, a lot of people email you questions. Most of them are questions I've already asked or questions that were so poorly framed that I couldn't even understand the question. But somebody asked me this one, and so I want to give that person an opportunity to get an answer. What do you like to do in the morning before you start work?
be careful here. Be careful here for a change of direction.
Work.
Remember, it's a plan. Again, you are here to hold yourself accountable. If you cannot hold yourself accountable, no one else will, right? It's not about being perfect. It's about if there is a change of direction and your intention was to day trade, that you hold yourself accountable. You will never be perfect, right? And by looking less at the exact dollar amount that you're up or down, you focus so much more on what's important, and that's the actual trade opportunity itself. We call it the blind trading challenge if you're part of our LPP team. Just a heads up.
Who you are, and you need to remember that this is not an opportunity for you to make a speech or tell the Fed what it should do. It should be a question, it should be short, and questions end with a question mark. So, come down here, want somebody, Joe, and then Jonathan?
Thank you. Joe Bellia from Brevet Howard. So you've spoken both about risk management considerations and the inherent danger of inflation becoming entrenched. So I was wondering, how much do risk management considerations suggest a terminal rate higher than would normally be expected to achieve your policy goals?
So I think there are a number of dimensions, and it wouldn't necessarily one of them would be potentially a higher rate, but more I would think one risk management technique is to go slower, right? To go slower and feel your way a little bit to what we think is the right level. Another is to hold on longer at a high level, and not loosen policy too early. I don't want to over tighten. Certainly, my colleagues and I do not want to over tighten because I think that cutting rates is not something we want to do soon. So that's why we're slowing down and going to try to find our way to what that right level is. But theoretically, it's another dimension, but it's not. It wouldn't be my first choice.
Jonathan?
And remember, we upload new videos every single day about the stock market. So if you're just watching for the first time, I would encourage you that if you're just getting into this, I upload new videos every single day. I would encourage you to consider subscribing, dropping a thumbs up, and anytime that you have any questions, please shoot me a direct message via Discord, first link, or shoot me a direct message via Instagram, and that's that third link in the description. If you want to watch me trade live as soon as tomorrow, you can take advantage of our sale, and that's that second link down below.
We're expecting that participation really moved back up all the way to a pre-COVID peak. And related to that is, the follow-on question, how much of the realignment do you think needs to be done through restricting labor demand as opposed to the ability of supply to catch up?
So, on labor force participation, I think it's useful to go back, 10 years, and the forecast that mainstream labor economists had was that, and you're right, aging of the population leads to declining labor force participation. Notwithstanding that, labor force participation was in effect flat and a little bit up from 2013 to 2020, roughly. And that was because you had a strong, tight labor market
One thing that we talk about pretty often within our Learn Plan Profit live trading session is progression. And if progression begins to slow down, an open position is a risky position. I'm thinking of selling my position, and it's because this thing is beginning to slow down. Just because I'm choosing to do something does not mean that you need to, but it's something to keep an eye on. If you see that you're no longer making higher highs and it's beginning to show signs of a resistance, especially when it goes from a break-even day to being up 8%, just take it into consideration where either reducing your position size or formulating an exit plan. You don't have to sell. So get that out of your head. You don't have to sell. But if it breaks below, let's say the EMA or whatever you make up of like, hey, if it breaks below this, I'm out. I'm going to keep some of these profits I just made. That's all I want you to plan right now. If you're a day trader and you intended to sell, if you're an investor and you had no intention to sell, then it's different. Just please, please, please look out for yourself. I don't care if you sell right now. My thing is have an exit plan at worst case scenario to keep some of those profits in your pocket.
To work during COVID. And given that immigration is well below the levels that were projected before the pandemic, does most of the balancing have to come on the demand side?
Well, I think for now, we have to assume that. That's why I talked about, supply side policies on labor, although they're not for us to recommend or to answer questions about.
Noted, please.
So yeah, the answer is yeah. I mean, that's what I kind of said that in my speech. We have to do what it takes to restore balance in the labor market to get back to 2% inflation.
Resistance at 2250 so far.
Really just by slowing job growth rather than putting people out of work.
Okay, Neil.
Thank you. Joe Gagnon, Peterson Institute. Chair Powell, back in 2018, you gave a speech questioning the role of the so-called star variables that the Fed uses to navigate. And there was a possibility raised that maybe unemployment could fall well below what the staff thought the natural rate U star was. Then, without causing inflation. But then COVID came and turned everything around. And as you just said, one interpretation of COVID is that U star went way up and we were on the wrong side of it, which is inflationary. My question is, going forward, do you think it's likely that things could reverse as the dust settles from COVID and we could end up back in that world where maybe we're on the other side of U star, we don't know it, it's hard to tell. What lessons did you learn from that period that got forgotten because of COVID perhaps?
Well, unemployment went below so what we write down and what the staff writes down.
That's not a good question. If you're going to ask him a question,
our longer run estimate of the natural.
That's what you're going to choose about COVID.
I guess one thing I would say is that during the course of a long, relatively gradual, so we only have one experience, right, to generalize from. But what I learned from that experience was long, relatively slow, not super fast expansion. You really saw the natural rate of unemployment, the shorter term natural rate, come way down. We had 3.5% unemployment with really little sign. Wages were just getting up to that level of productivity and 2% inflation. So we could be back in that place. I think we could certainly be back in that place. But what we've seen, it's another N equals 1 situation.
Beautiful.
With the pandemic, it's also unique. I would also point out, though, we did see the inflation we saw at the beginning. We did have
remember resistance range
go up probably significantly, but the original inflation we saw.
Oh my gosh!
With the labor force curve, it was not to do with that. It was to do with goods more.
So I think another way to frame Joe's question is, I think a lot of us thought that the lesson we learned when unemployment fell very far and we didn't get inflation, that maybe over time, before you were in charge, the Fed was erred on the side of being too tight. It was too worried about the unemployment rate falling. And I think the concern is that, will we fight the last war? And because of this experience, the Fed will be reluctant to experiment.
I'm not up 100K. I promise you that. I'm not.
I'd love to have that problem again. If we can get back to,
Okay, so you got like 3 years left in your term. You think you can pull this off in the next 3 years so we can run the N equals 2 experiment?
Absolutely. Yeah.
Claudia Sam?
Claudia Som Consulting. So the question I had is, we've had unexpectedly fast and large rate increases this year, and that has pushed up the dollar relative to basically any currency in the world. We've seen likely more financial market instabilities. So the Federal Reserve's dual mandate is for the United States, and yet are you worried that a severe global recession or financial market turmoil would come back to make it harder for us to achieve the U.S. dual mandate? Thanks.
So we do, of course, look at global developments. We have a domestic mandate, of course, as every central bank does. But in this world, global financial markets and the global economy really matter for us. So we monitor all that very carefully. We really think, and my colleagues and I really think, that the best thing we can do for ourselves and for the global economy is to get inflation under control as quickly as possible. We don't think the world's going to be a better place if we take our time and inflation becomes entrenched and then we have to go in later. The evidence is that the employment costs of bringing inflation down only rise with delay. So at the same time, we don't want to do any more than we have to do, but we feel like as a risk management matter, we needed to do what we did, and feel like we're now in a place, again, as I said, where we can slow down and try to reach that ultimate level.
But how much do you worry about what Claudia's question implies is we do something with rates, other people are forced to do things with rates, and that ends up spilling back to us and makes it harder for you to do it. So you have to take that possibility into consideration.
We absolutely believe that we take that into consideration. The model's explicitly taken into consideration. Of course, they're not perfect. No one would say we do it perfectly, but we have a very large global model that we use for the global economy, and it absolutely takes into account what's happening with the real economy and monetary tightening and currency and all those things. It won't be perfect, but we do that. And we also sort of understand generally that there's a lot of research and things, people are talking about this a lot right now, that, maybe the whole is bigger than the sum of the parts when it comes to tightening. Maybe it is, maybe it isn't, but we're aware of the risk of that. But again, I come back to, look where we are. We've raised, 375 basis points. Markets are working.
2280.
We're now in a position where we're in a place
QQQ, NASDAQ, we're almost at 290. This is huge.
One is at 3.7%. So we haven't done, I don't regret getting to where we are. And I think broadly, the world is better off if we can get this over quickly.
10% day. If you're part of our Learn Plan Profit group, we talked about it. I mean, it could have gone either way, right? We waited for there it goes, 10%, TQQQ. 10.
Can I ask two questions?
If they're short.
Yeah, very short. So one question on the labor market is, how do you reconcile, the characterization of the labor market as very tight with the fact that wage growth isn't keeping up with inflation and the labor share of GDP really hasn't risen since 2020? And then second question is, how much credence or what kind of research do you rely on?
Be careful here, be careful.
To think about the notion that a very tight labor market will lead firms to invest in and innovate.
Well, they're asking more questions now about, I think now a big concern for a lot of people is, it is to be said, this is going to be the recap, right? So what was the whole point of this? Everyone wanted to know if the Federal Reserve will begin to moderate how aggressive they raise interest rates. And that is exactly what Jerome Powell said. So if you go back to the interview, the last paragraph that Jerome Powell said, and the host thanked him for saying it, where he didn't have to ask about a 0.75% or a 0.5%. They said that they're willing to moderate interest rate hikes as soon as December. It does not mean that they're going to stop interest rate hikes, which is a concern or a question that a lot of people had, but they said that they will begin to moderate as soon as December. Did I say September? I meant December. So that's the next interest rate hike. And I'll make sure that I live stream that on our YouTube channel as well for free, right? I cannot stress this enough. So I'm very grateful for the NASDAQ market going up. We waited for the market to react. We took advantage of this opportunity. If you're part of my LPP team, that is all we talked about, of waiting for the market to react, waiting for the market to react. Not predicting, not hoping, but waiting for the market to react. Now that the market is this overbought, it doesn't have to pull back, but it wouldn't be a surprise if it begins to give back some of its gain. A 10% day is very significant. I'm only talking to you day traders. If you're an investor and you have no intention of selling anytime soon, hold your position. I'm not here to speak to you, right? But if you're a day trader, these are not the times to be greedy. There's always more money to be made. All I ever want you to do is, even if you follow with a trailing stop loss or a stop loss, something that if it breaks below a specific price point, you allow that stock to continue to try to rally to make more money, but there has to be a breaking point that if it breaks below something, you're just like, all right, I'm going to cash out and I'm going to keep at least $500 profit, $1,000 profit, whatever it is that you're up already. Please, please, please look out for yourself. The Federal Reserve, Jerome Powell just said that as soon as December, they intend to moderate their interest rate hike. This is what the market was waiting for. So it was the very last paragraph of what he said. Do not be surprised if the market screened today, but possibly if in the next couple of days, the market could always reverse, right? We still have, this was the most important thing for this week to my understanding. But we have next week, and then we have that CPI data report early to mid-December. We still have a lot of things around the corner, right? I live stream every single day for my Learn Plan Profit group. They're private live streams. That's where you can watch me trade live. It's where I share my thought process. You do not have to join, but if you want my time, if you want my assistance, if you want to work with me on a closer basis, I offer one thing, and it's the Learn Plan Profit team, and that's that second link in the description. And we're running our biggest sale. It's $150 off, so you can choose to join. Also, I wanted to let you guys know for the live stream, you don't have to do it, but if you guys head on over to shoptechbuds.com or the fourth link in the description down below, we are running a free flag sale. So a lot of you guys liked the flag that I had behind me. You get a free flag with every order today. Just add it to your cart. So if you want a Wall Street shirt or you want a mouse pad, add a flag to your order, and at checkout, it will automatically discount the flag for free. No coupon code needed. That's just for you tuning on in into the Fed live stream. And again, we're going to host more of these later down the road. So if you're part of my Learn Plan Profit team, I'm going to share with you my profits. If you're not, I'm going to post it on Instagram. But again, this is, I'm very grateful for today. And I am in awe. This was a solid setup, market momentum, direction, right? It's amazing. So I hope that you guys enjoyed this stream. I hope that we earned your thumbs up. Please consider subscribing. If you're absolutely new to the stock market, I welcome you to send me a direct message via Instagram or via Discord. And that's that first or third link in the description. I cannot help you if you do not reach out. I will never reach out to you first. Those are all fake accounts. I have one Instagram and it's verified. Third link in the description, or send me a direct message via Discord. I offer one thing. It's my Learn Plan Profit group. That is all. I offer nothing else. That's that second link in the description. I appreciate your time. Like always, let's make sure that we end the year on a green note. Take it easy, team. Wow. Love it.